All right, testing 1 2. All right, boys and girls. Today is, let's see, we got the 9th of May, and here is the activity from the 3-minute chart. So, first 3-minute candle open here, and we had a high opening range of 517.77, and then a low range of 517.34, which gave us a range of about 43 cents for that candle. So on the next candle, it was kind of a doji, so that was a heads up for me that if the bottom of this get taken out, then that would have been a sign to go puts. Now, as you can see, when this candle completed, it printed inside above the line and was not a trigger for me. However, if I would have been a little more aggressive and taken this here as it breached below this little line here, this little wick here that was kind of almost a doji, I probably would have gotten my 6% and gotten out. So I did not get 6%. I actually got stopped out, but looking at this trade here, I did not do anything wrong. I followed the rules. It just did not work today. So here is the trade for today. So now, as you can see on this bottom chart here, we took our put position at 940, which was, hang on, 940, which would have been on this candle here, between this candle and this candle, 939 and 942. So because this is a 3-minute candle, it doesn't show the exact time on the entry, but it would have been in between these two candles. Now, the market pushed down a little bit. I think I was at maybe a 4% and was just waiting for it to push down further, trigger, and get me out on 6, and it did not. So as you can see, when I saw these 3 green candles right here, I drew a trend line, and then on this candle here, my moving average and my VWAP crossed to the upside. So that was a strong indication for me to get in some calls, and that is what I did at 951, which would have been on this candle right here. 951, we got in on some calls as we were starting to move up. And as you can see, that particular position filled in like about 8 minutes, and then I got stopped out of my puts. So we technically, if you want to do the math on this, we lost 140 bucks on the puts, but then we went back in on calls. We did 4 contracts instead of 5 since they were a little cheaper, and got back half of our loss. So I net lost $70 on today. Okay, that was SPY trade, so SPY was a net loser of 70 bucks today. Now, on SPX, let me get this slid over here. This is the chart on SPX. This is a 15-minute chart on SPX. Got 15 minutes. I threw in implied volatility as an indicator here because didn't get a whole lot of juice or premium today on this trade. So let me explain what happened on this guy. Give me 1 second here. So on this particular trade here, this is the first 15-minute candle here. We had a high of 51.92.21. Bottom was 51.80.41. Now, when this second candle printed, it was inside, so there was no trigger. And then the trigger came here on this candle here at 10 o'clock. So now, I've got all these lines and stuff marked here. I'm going to erase these here in just a second, but I just want to explain to you what happened. So when I got in the trade, we had the trade fill at 10:05 because I wanted to get 50 cents credit. So 10:05, we filled in between this candle and this candle here at 10:05. So once that filled, let me get the trade ticket over here to show you what we're talking about. We sold the 5170 puts and we bought the 5165 puts for protection. The selling part was $1.87. The buying part cost $1.37. So you got a net credit of 50 cents per contract. As you can see, we did 4 contracts here. So we had the difference between $5, which is these two strike prices here, is $5 minus the credit received 50 cents, which is $4.50 total risk on the vertical trade. 450 times 4, we had 1,800 bucks of margin power being used to get in this trade. Now, as you can see, once we got in the trade here, it just kept going higher and higher and higher. Now, the videos and people that I've been watching do this strategy, they take their 50% of their profit and they get out of the trade. So net on this one, if I would have taken that, it would have been $100 on this trade made. Now, since I am trading in an account that's less than 25,000, the pattern day trader rules apply to me. So if I got in and got out, you can only do 3 round trip trades in a 5 business day time period. So I wanted to save one of these for tomorrow so I can trade tomorrow. And because I did, I let this guy expire worthless, which means that I keep all of the $200 credit because SPY never came back down to this area. Now, 5170 was my line in the sand where my short strike was sold, and that would have been approximately right here on the chart. So when I entered the trade here on this candle, all I needed SPX to do was stay above this level here, and I would have got all my money. So if SPY would have stayed, or I'm sorry, SPX would have stayed above 5170, if it came down here and as long as it stayed a penny above, I would have been able to keep all of the credit. Now, because I had to leave, I set all of these alerts to where if this level would have been breached, it would have sent an alert to my phone and also to my email for me to take a look at my position. So I had 4 levels marked, and as you can see, none of those guys were breached. So we didn't take any heat today on this trade. So the SPX vertical strategy, go ahead and erase these all out, worked today. And this guy actually has worked 4 times this week that I traded it. I got my money. So this strategy seems to be working. I still have a little bit more days to go on my 25-day data set, but we're in the process of recording that right now. So there you have it. Have a great day, and hopefully tomorrow will be another good trading day for us. Thanks.